So we are so fortunate to have some of the guests that we've had come here. This is someone that I am just so excited to be able to introduce to you. This is one of the most exciting people that I have met over the last few years. His name is Murray Hidary, and Murray is one of those people that you kind of only read about, you don't get to meet. Several years ago, he started a company called earthweb/dice.com and took it public. And I don't know if you make a lot of money when you do that, but I hear that sometimes money is created when you take companies public. And ran a public company, sold that, started another company, Vista Research, built that company up, sold it, and now he's working on another business that is amazing. I mean, it's just in every possible way. Maybe he'll tell you a little bit about that company. It's iAmplify. And the reason why I'm so excited about Murray and why I've really enjoyed getting to know him is that not only is he a cool business guy, like really loves business, but he's a really interesting guy too. He's a photographer, he's a musician, he's just an all-around adventurer, and he does a lot of amazing stuff with his life. And every time I hang out with him, I leave and feel like I've gotten smarter as a result. And I consider Murray to be a friend and a mentor, and I just want to welcome Murray Hidary. Thank you. Thank you for being here, my friend. Thank you for coming.
My pleasure. You know, I just want to say before we start, first of all, thanks for having me here. Tremendous turnout, great crowd. I've been sitting in on a lot of the sessions, and it's just an incredible experience for everybody here. I kind of wish I had this back 10 years ago when I started my first companies. And, you know, I've had the privilege of knowing Eben now for quite a bit of time, and we've spent some great time together. Recently, I met, anybody know here who Tom Friedman is, the New York Times columnist, Pulitzer Prize-winning columnist. Incredible, he wrote the book, The World is Flat, for those of you who have read that book. And that's somebody that I've had the privilege of spending some time with, and he is able to synthesize world political and economic trends and distill it down and synthesize it into some incredible thoughts, and has become a thought leader in that world. Something that I've come to understand about Eben is that one of the reasons why I enjoy our friendship and relationship so much is because he's able to take information, particularly in the areas of business and lifestyle, and bring multiple resources and information sources together and synthesize them into and distill them down into exactly what's needed. And that's clearly what everyone here is getting. So congratulations for that.
Thank you very much, Murray. One of the things that, thank you. Murray has not only started a lot of businesses, but he also has advised businesses and been on their boards and loves entrepreneurs, entrepreneurialism, startups, raising money, venture capital, taking companies public, and all of this stuff that is really mysterious to a lot of people. And so I was wondering if maybe you could talk a little bit about, maybe even tell a couple of stories, or talk about how you got into this thing and some of the things you've been involved with, just to give a little bit of background.
Yeah, there's so many places to start, so many stories. You do accumulate a lot of great stories along the way as you put yourself out there more and more in the business world. The first thing I'll just start by saying is, I don't think it's ever been a better time to start a company than today. And really looking at the history of human civilization, I don't think it's been a better time to start a business than it is today. And that's for a lot of reasons, including the ability to reach customers globally has never been easier than today because of communications, telecommunications, internet, etc. But also because of services that are out there. You know, I remember starting my first company in 1994, and we really had to scramble and do everything ourselves pretty much and pull all that together. But today, just like we were just talking about previously in terms of outsourcing, you're able to pull together so many incredible resources that are at your fingertips, just a click away, just a phone call away. And one thing I would encourage anyone starting a business today to do, and I do this myself when we have new ideas and we start them, is to look at what is core to your business. What is the thing that you do better than anybody else? Focus on that. And anything else that kind of is more run-of-the-mill, outsource that. Examples would be a finance department. I don't think I've ever had an in-house finance department in any of my recent companies. That means someone who's really a CFO type person. At a certain scale, then you need to bring that in. Obviously, when you go public, you need to have a CFO. When your business achieves, very large amounts of revenue, you need to bring that in. But in the beginning, in those early stages, you don't need to have that. You can have an accounting firm that you outsource to. That's something that we do, and it works really, really well for your QuickBooks and for your check writing and expense management. Another area is office space. I know a lot of folks are able to work from home, but say you have a team and you want to have everybody together. Nobody should be signing a lease for 3, 5, 10 years until they're a much more mature company. Today, you can find office spaces that you can share with other people. Actually, one quick story, now we've grown our recent business to a point where we need a large amount of expansion space. So one thing I've learned over the years is it's kind of a double-edged sword. On the one hand, you don't want to pay for too much space. But on the other hand, you also don't want to run out of space and have kind of that sardine syndrome of people working on top of each other. Ruins morale, and everyone kind of, gets upset coming into work every day. So what we did recently is we took the entire floor of this one building. We only needed about a quarter of it. And we were then able to have other friends' companies come in and use the other space on a short-term basis, month by month or 3 months at a time. And then as we needed the space, we then took it back from these folks, and then they grew and got their own spaces. By some kind of strange miracle, we actually were able to reduce our rent roll to 0 for our company because we brought in these other companies to take the other space, and they essentially subsidized our portion of the space. So one of our investors kind of came in at a board meeting, he scratched his head, he said, I don't have any other company that has actually made a profit center out of their rent. So that's just innovative ways to really reduce your expenses and kind of a win-win for everybody. But when you think about starting a company, as Eben mentioned, I've never taken a business course in my life. I was a music major at New York University, and my dream and my goal was always to write music and play music, and I still do that today. But what I consider myself, and people say, oh, he's a business person and he's had some success here or there, I actually have never even viewed myself as a business person. I view myself as a creative person, as someone who comes up with ideas and has the ability to execute on them. And that's really what differentiates an entrepreneur from pretty much everyone else out there, is the ability to execute on an idea that you have. In every dinner conversation with friends or just hanging out with people, everybody's got great ideas. Everyone in this room has got great ideas. Everyone that you meet has great ideas at one point in their lives or another. But the question is, have they been able to take that idea and make it happen, turn it into an actual company? And that's, to me, what differentiates between just someone who has got a great idea and someone who's able to build a real company and build value out of that.
So what are some of the things you've seen that an entrepreneur who's growing a small company, maybe it's doing a couple $100,000, $1 million a year or something, they're getting started, a small team, that that you wish you would have known when you were their size? Yeah,
that's always a good one. And I think the key one that comes to me is people. One thing I think that limits businesses that I've seen out there is fear to a certain extent. I think a lot of people are afraid of growing their business. They're afraid of what it takes to grow their business. They're afraid of losing control over their business. They're afraid of failure, obviously, if they grow too quickly and they can't handle it. There's a lot of reasons why they might be afraid. And it's important to be honest with yourself and say, kind of, what's stopping me from taking it to the next step? And I will tell you, most times, it's something emotional and less financial or market-driven. And so I think if you can identify what is it that's kind of holding me back. I'll give you an example. Somebody I know has a business that sells dishes and everything for the table, glassware, dishes, etc. And it was doing well, just that range, a couple $100,000, $300,000 about. But she couldn't relinquish control over every little detail of the business. And so anytime she hired somebody to help out, there was always a problem. They didn't do that well enough. They made a mistake on this particular invoice. They made a mistake on that spreadsheet. And so she kept on having to find new people who were able to do it, but she was never able to find someone who did it like she did it. And you know what the truth is? She never will. She will never find someone who can do it as good as she can do it, because her passion is in it, her life is in it. That's what she lives and breathes. But it's important to be okay with finding someone who can do it 85%. I'm not saying 50% is good, but 80%, 85%, 90%. And be okay with that margin of error of 10, 15%. Because that's what's going to make the difference between you being able to double your business and use your time to get in new customers to market versus having to deal with all the, crossing the T's and dotting the I's. So being able to bring in good people, but also trust them, empower them, and be okay with 90%. No one's going to have the same passion as you are about your own business. As much as you incent them, give them great motivation, give them a great bonus package, give them a good salary, even give them options or shares in the company, it's not the same as if it's your baby. And don't expect them to think that it's their baby as well. Expect them to have passion about it, but it's never going to be the same as yours. So be okay with them kind of, doing a good enough job. In Chinese philosophy, they have this concept of the art of leaving things undone. We're so consumed by a society that we have to finish everything, and we have to-do lists that are this long, and we can't rest or feel peaceful or restful until we finish everything on that list. But it's okay to leave things off the list. It's okay to leave things undone. And as long as most of the work is getting done in a professional way, then that'll let you actually expand your business and keep the ball moving forward.
And the reality is, if you have a strong passion about it, attention to all the little details, and then you bring someone in that can do an 80 or 90% job, the customer might perceive a 1 or 2% difference, or maybe they would just never even notice it because they wouldn't know the difference anyway, because they're just experiencing your service. So when you take the perspective of the other person, you realize to scale, to actually make something that can grow and multiply, it's going to have to be replicatable by people other than you.
Absolutely right. I'll give you another story of a story of scale. And this is a story of a business that went from $6 million in revenue, quite sizable, to 10 times that in a matter of only a few years. So how do you achieve that kind of growth? This is a company that Eben mentioned, this company, Dice.com. I don't know how many people here are familiar with this website, but it's a website kind of like Monster, but just for tech people. So if you're looking to hire a tech person, you would go to this website, Dice.com. And it's a job board for hiring computer programmers and other people in the IT field. Well, this is a company that I happened across in 1999. At the time, we had just taken EarthWeb public. That was in November 11th of 1998. We took that company public. Thank goodness it was a tremendous success. And I will tell you that taking a company public in America is the real culmination of the American dream. I mean, that's, you're steeped in the capitalist system. There's nothing more capitalist about taking a company public and seeing your shares trade on NASDAQ or whatever the exchange is. Actually, my personal kind of dream was to have Maria Bartiromo from CNBC. I don't know how many people watch her on CNBC, but exactly. Thank you. I didn't want to say that, but you did it for me. Having her announce my company and the ticker symbol on CNBC, and she did, and it was pretty cool. But one of the things that we did after we went public, what does going public enable you to do? It enables a few things. Number one, it's an exit strategy for shareholders in your company. So if people have invested with you privately for many years, when you go public, now there's a market for each share in the company. So if somebody invested in your company, say at $1 per share privately, and you gave them a piece of paper and you said, okay, you have 1 share of my company, and thank you for your $1. When you go public, let's assume you go public, you've built value from when they invested, and now let's say it's $10 a share. They now have the ability to take that piece of paper you gave them, however many years earlier, and in an open market, in a free market, in a capitalist system, they're able to exchange that for cash. And so now they can say, I have 1 share, I want to exchange it, and whatever the market will bear, they will get for it. If people think it's worth more, they're like, okay, it's worth $10. If it's worth $20, they'll pay that. And now it becomes a liquid marketplace for you to exchange your shares. And so it's a tremendous exit strategy for investors in private companies. Obviously, it's also a place where you can buy a company at a certain price if you think it's going to go up, and make a profit that way. But the other thing it enables a company to do from a corporate perspective, strategically, why is it important to go public? Because it gives you a certain amount of shares or equity to go out and grow your business with. So it's one of the best ways to grow your company is by taking it public And two things happen. Number one, you have a lot of cash you raised from the market because you sold shares in the market, and now there's a lot of cash in the company to go out and grow the business, working capital, buy technology, computers, hire people. You can actually use it for mergers and acquisitions, buying other companies, advertising and marketing. So there's a lot of reasons why you would want that cash into the company. The second is the actual shares or equity in the company. And you can go and find a company that strategically fits with yours, and now instead of giving them cash, you can give them shares in your company. And by doing that, it actually saves you the money and gives them a tremendous amount of upside by the future value of those shares. And that's what we did as a company back in 1998 after we went public. We had a very successful M&A strategy for our post-growth as a public company. We did about 25 different acquisitions, mostly in the technology space, websites and other services that fit in with our strategy. One of them was Dice.com.
So basically, you took the company public, and then you used stock to buy 25 other companies.
That's right.
Okay.
That's right. Sometimes a combination of stock and cash, but mostly it was the stock. And I came across a company called Dice.com based in Des Moines, Iowa. We're based in New York City. And I found this company in Des Moines, Iowa. Two founders controlled 50% each, grew it from scratch. They've been running it for many years. They were doing about $6 million in revenue, about 36 employees at the time, tremendously profitable, 95% gross margins. That's tremendous business. And so we looked at it and we were like, that's pretty incredible. Amazing scale they had in profit of the business. So we did a deal with them. It fit in perfectly with our model, and we acquired the business. They came on board and kept running their division. But one thing was very peculiar. They couldn't grow it as fast as we thought they could. Think about it, 1999. How many people, how many companies were hiring technology? Everyone was hiring technology people. Why couldn't they grow this a little bit faster? And when we dug in, we realized that they were only accepting money and job postings from recruiting firms, headhunters. So if you were Microsoft, you actually couldn't post a job opening onto the site. You'd have to be a headhunter or a recruiting firm, kind of a middle person, a middleman, posting and then taking that resume over to Microsoft. So they were only making their money through recruiting and headhunting firms. That's a pretty good business for only focusing on recruiting and headhunting firms. So we went to them and we said, well, what if you open this up to the vast world of corporate clients? IBM, Microsoft, Cisco, Intel. These companies are hiring technology people by the thousands. And they said, well, we can't do that because our current customers, the recruiters, the headhunters, are going to be upset with us and pull the business, and we're going to lose all of our millions of dollars of revenue. And we can't take that risk. Now you think about these two founders that grew this business. They were pulling out probably a couple of $1 million in profit every year. And they're not doing anything to upset that, right? So we said, well, that's great business, but we think we can grow it even further and make that $2 million in profit even greater. And because they were a private company and a startup environment, they were not willing to take that risk. Talk about fear. They were afraid of losing all of that revenue and upsetting their customer base. But now that we were a larger company and we can take that risk, we have the working capital, we have the resources, we did take that risk. And today, Dice.com does close to $100 million of revenue. So, and there was never any downturn, there was never any, the recruiters at first, they were kind of grumbling and they were like, oh, you know, how'd you do this to us? We've been so loyal. And you know what? They got over it. It's a great service, and all the companies came on, they stayed on board, and the company just, you know, took off. So, again, an example of how you overcome fear and how you push through that barrier, because they hit a wall, they hit a barrier. And the only way to push through it was to take a very serious but calculated risk, and it paid off.
Yeah, from the people I've known that have run public companies or taken companies public, I understand that it's the closest you or I will ever come to being able to print money.
Yeah,
on our own.
Pretty much. It's an incredible experience. Today, it's a slightly different environment with something called Sarbanes-Oxley. These are two congressmen, senators that passed some laws that make it a lot more filing, registrations, a lot more scrutiny by the SEC into public companies, a lot more disclosures, all good things at the end of the day for the shareholder, but it makes it a lot more difficult from a public company point of view to actually get your work done. You can easily spend millions of dollars in legal fees just being compliant with all of these laws. And then there's just a lot of scrutiny and a lot of work that a CEO in particular has to spend in just dealing with that side of the world. So you have to really take a step back and understand that it's a great course to go, but it requires a tremendous amount of time, tremendous amount of effort, and resources to actually maintain that. That's something that's true to raising money overall. One thing that we always believed as we grow our businesses is bringing in outside capital. Outside capital is a tremendously important way to grow your business. A lot of people are tempted by, okay, I'm only going to use the money I have for two reasons. One, I don't want to be in debt. I don't want to owe anybody any money. And I think it's a mistake at the end of the day, because you can really gain tremendous leverage at a very low risk if you can bring in outside money and put that to work. The other reason is people say, well, I don't want to bring in other money because I'm going to dilute myself in my company and have less shares, and so I don't want to give up the potential profit. Again, short-sighted, because you can grow your business much faster and make it worth a lot more if you have that outside capital. Not just the capital, but if you can get what we call smart investors, people who know people, who have networks, who have resources, then they can help you grow your business even further through customer contacts and other resources. So that's an approach we took in every single company that we've started, and it's really paid off. To date, I think we've had many shareholders and investors come into the company, from individuals, friends and family, as it's called, to institutional investors. These are some of the largest venture capital firms out there that can really help you grow your business. And to date, we've probably raised a total of about $200 million in all of our businesses in capital, but we've returned over $1 billion in value to those shareholders. So I don't think we would have achieved that if we were just kind of scraping by and trying to, pull all that together ourselves. So again, taking the big picture approach, I think, is really important.
So let's say that I was an entrepreneur. I know that you're all about growing businesses big, fast, because that's where, there's a lot of value there. If I wanted to raise some money from friends and family, what are some of the things that I should know, some of the things I should do? And if I wanted to raise some money from an institution, what should I do? What should I know?
Yeah, it comes down, the whole system comes down to trust. Even the public market comes down to trust, right? You are willing to pay $10 a share for something because you believe that there's a piece of paper that you can then redeem one day for $10 a share or more or something. So the whole system is based on trust. Anyone who's ever invested in us, and anyone we have invested in over the years, you're investing in people. I don't care what the idea is. Most of the time, turns out, they've actually studied this. Venture capital firms have studied this. A venture capital firm will, say, invest in 10 companies in a given year. I would say one or two of them might be doing the same thing a year or two down the line than what they actually invested in. The model will have tweaked a little bit because of the marketplace, because that's just the nature of it. Our companies have tweaked a little bit since we started them, just because you learn as you go. And so it's important not to invest in the idea, but to invest in the person. And so from your perspective, as someone investing in your company, that has to be, first and foremost, is that they're investing in you, and you have to make them comfortable with you as the leader of the company, as someone who can navigate through that sea of constant change. Someone they can trust with not only with their money, but who can put the money to best use and can really watch the trends in that particular market and take your idea and make it even better throughout time. So that's a really important skill to have. Something Eben and I always talk about is, in the way I view it, you're not so much building a product, you're not so much coming up with kind of the next cool thing, as you are packaging and positioning a company. Your product is the company, and that's how I view it. Now, what you happen to make, whatever widget, if it's a stool or if it's a website or whatever it happens to be, that's almost inconsequential to how you think about building this company, which is in and of itself the product. And if you look at, our businesses, we have built them to grow fast, and then we built them with an exit in mind. And that's an important thing to think about when you get into something. What is the exit going to be?
Can I just say, if you didn't write that down, you might want to write that down. Product is the company. What if you thought of your company as the product that you were going to sell? You said something to me, I think the time before last, we were in New York, we were sitting around, and it was, every time we hang out, you say one thing, typically, that I have to think about for about a month. And you said, well, maybe you could say it. How have you made your profit, and how have you not made profit?
Oh, right. Yeah, it's interesting. I've actually never made a single dollar through salary or bonuses or any typical way that people earn an income. Yes, I have a basic salary that I get paid by these companies, but at the end of the day, any amount of wealth or value that I've built for myself has been through shares, through equity, through owning the company and selling it through an exit. And that's what I have in mind every day when I come into the office. I think about how are we going to make this company, which is the product, how are we going to make this thing, this baby, this thing we're building, really valuable, and who's going to want it? You got to think about who's going to want this company, right? Not just the product you're making, right? Who's going to want this particular service, or who's going to want this, but who's going to want this actual company? And I think about that every day. And the reason why that's important is because, number one, it will actually be an incredible discipline to your day-to-day operations of whatever it is you're actually selling, whether it's motor oil or whether it's a service on a website. I don't care what it is, but it'll make you think about that product better. It'll make you think about profit margins. It'll make you think about growth. It'll make you think about market potential. How big is this market? Are there 10 people who are willing to buy this, or 10 million people willing to buy this? And so it'll make you think about all that stuff every single day, but in the back of your mind, you're always thinking, what's my exit? Where am I going with this? Who's potentially going to be interested in what I'm doing here every day? That's important because I recommend making those connections from day one. If you're at some point thinking you're going to sell your company, don't look for the buyer of that company when you're ready to sell it. It's too late. You have to look for the buyer of that company the day you start the company. That's when you look for the buyer of the company. Now, you don't let them know that, right? You don't tell them, I'm looking to sell my company to you one day, so I want to create a relationship with you. No, you don't say that. You say, you develop a relationship, maybe there's a way to work together, maybe there's a way to create a partnership, distribution partnership, or you know what? Just create a friendly relationship so that when you are ready, you can make that phone call and it's a friendly phone call. You can make that phone call and they know who you are. They're going to take your call. And they're going to sit with you and have coffee, and sit with you and have lunch, introduce you to the right people, and the next thing you know, a deal's on the table. Because the credibility, the trust, we talked about trust a minute ago, the trust is already established. That's half the battle. Whether it fits with the company in terms of what they're going to pay for it, that's almost inconsequential. If it's valuable to them, they'll pay what it's worth. It's not about that. That's a very easy conversation to have. And that actually takes a very short amount of time. But the relationship, who is this guy? What kind of company does he have? What is this about? Most of the time, it's about knowing the buyer of your business well before they actually buy the company. I can't even stress that enough. That was true for our second company, Vista Research. This is a business we built back in 2001. We started the company. Okay, talk about, is it a good time to start a business or not? How many people here would think it's a good time to start the business a month and a half after 9/11 in New York City, downtown in the financial district, in a recession? No one, right? It's probably the worst time you'd think to start a business. Turns out it was one of the best times to start a business because, number one, we were able to hire people at a time when people were being forced out of work. We were able to hire people for less money than they were making just a few years earlier in the boom of the technology rush. We were able to put capital to work in a much more efficient way. We were able to buy things cheaper, computers, every office space was much lower. So the cost of starting the business was much, much lower threshold. We were able to get more attention because there's less competition. Who else is starting a business at this time? Nobody. So there was less noise, that kind of signal to noise ratio. There was no noise out there. Whatever we said, everybody heard it because there was no one else speaking. And so it was actually a brilliant time to start a business. Now, there's a catch to that, right? The catch is you have to be able to get the money to start the business in a time when no one wants to invest anything. So as long as you can get access to capital, and that's an important term, access to capital, that's either your own capital or capital through individuals that you know or institutional money. That's venture capital firms or professional money investors. As long as you're able to get access to that money, it's the best time to start a business, is in a low economic point. When it's a boom and everybody is starting companies and everyone's trying to get the same talent and the same office space and everything, it's a very challenging time. It might be easy to get money because everyone's investing, but it's a hard time to actually execute. In a recession or a low economic point, it's a very easy time to execute as long as you get access to capital. And then that comes through trust, building relationships with investors over years. We went to the same group of investors who invested in our first company. Here's our idea. They said, we love it. They gave us the money. We were off and running. And so if you look at Vista, we started that company, and it was a company that had a network of experts for hedge funds and mutual funds. So if you're a hedge fund looking to invest in a stock and you wanted to get advice from someone who works in that field, you would come into our web-based network. And the model worked very well. It was one of the first of its kind. And so we did something innovative, and we were able to get to the customer. But one thing we did was, we realized this business would ultimately be sold to a large media information player or a large financial player. And so we got to know, we went to all the conferences. That's one of the best ways to actually reach out and build a network and find the potential buyer, is going to conferences, meetings, and just building that network out. We built those relationships and eventually did sell the company to, in this case, McGraw-Hill, one of the largest information media companies. And again, the relationship was there. It was an easy conversation to have. And today, Vista is part of a division of theirs called S&P, Standard & Poor's. S&P Vista, and they've now tripled the business since they acquired it back a couple years ago. So they're thrilled, and it's a win-win for everybody. But again, we knew them well before we sold the business to them. And so that's something I really can't stress enough.
Who just learned something? Okay, good. Thanks, Murray. So let's say I wanted to raise some money, and I didn't know what I didn't know. What would my first step be?
The first step would be, don't underestimate the amount of time it takes to do it. It takes a lot of time. And that's not a bad thing. You just have to know it. You just have to know that's the case. Especially if you're a CEO entrepreneur, you're heads down, grinding away at your business every day. You just have to know how much time it's going to take. There's a lot of meetings, there's a lot of follow-up, there's a lot of paperwork, there's a lot of legal issues, there's a lot of spreadsheets to make, there's a lot of projections to make, there's a lot of stuff to do. So don't underestimate the amount of time it takes. People say yes, and then it could take 3 months to actually get them to write that check and to sign that paperwork. So thinking about raising money, and it actually doesn't matter how much it is. You might say, well, I'm only raising $1 million, I'm not raising $100 million. It actually doesn't even matter. Sometimes it's harder to raise $1 million than it is $100 million. It sounds crazy, but it's true. So it's important to recognize it takes time. It could take up to 6 months to raise money. That's been the case in several of our fundraising efforts. Now, that's going to be a function of a few things. One is how much you are trying to raise, but what valuation you're trying to get for your company. Do you think your company is worth $1 billion and you just started it a week ago? It's going to be tough to raise money. Are you putting something reasonable out there that is going to be fair to both the investor and to yourself? Then it might take faster. So there's a lot of details in that, but the first thing to recognize is it's going to take time to do. Set aside the time, and in certain cases, get help in that process. So that means, number one, get a great law firm. Get a great law firm that can put together those documents and just check off all those different all the paperwork you need to get signed and done. A lot of those are forms, by the way. This stuff has been done a million times before. So any law firm, any corporate law firm, worth its muster will have these forms ready to go. You don't have to pay huge amounts of money for these things. So make sure you ask, do you have a form investment agreement, subscription agreement ready to go. And they will have that. And you might want to tweak it a little bit, but these are forms that are ready to go. The second thing is it's going to take time, so you may want to have somebody help you. And there's a whole range of people that can help you. If you're a startup, small company, and you're not raising a tremendous amount of money, there are individuals out there. They might be former lawyers, former investment bankers. Network around, ask people who you know. And for a relatively modest fee, something in the range of 5% of whatever you raise, they'll be willing to help you out, introduce you to their network, and help you manage your own network. Don't underestimate how much time it takes to call 50 friends and family and meet with them and get them to understand what you're even talking about. I remember one investor who invested in 1995 in EarthWeb, which was one of the first internet companies that started up back in what we call Silicon Alley, which is the Silicon Valley of New York. And I met with him, and he said, after an hour meeting of kind of me talking there and telling him what we do and what we plan and all these big ideas, he says, I have no idea what you're talking about. That's why I'm investing in you. so he was someone who was, an older guy. He was very successful in the toy business, and he just, didn't know anything about technology, or certainly not the internet back in 1995. But he liked the passion we had for the business, and liked what we were saying, and liked our commitment to it. And again, he invested in us. He invested in the people. And the fact that he didn't understand it actually made him feel comfortable, because he said, if I understand it, it's probably not a good idea. so that actually worked out really well. And today continues to be a good friend and shareholder in all of our businesses.
Kind of the opposite of Warren Buffett's theory, huh?
That's right. Totally different theory to that.
Seems like it works, though. I mean,
it worked for him.
Pick the right people. Yeah, right. Interesting. And so let's say I am interested in raising some money. From your experience and seeing companies that have done it, I hear that there may be a dark side to it. There may be some challenges in some places, things that you wouldn't know that you don't know.
Yeah, that's like anything. There's two sides to everything. Most of that has to do with who invests in your company. And just as they're investing in you because they trust you, you should only take money from people who you trust, because any experience in a company is going to be up and down. There's going to be an up and down in every company. Doesn't matter what company it is. There's going to be tough times, better times. And so what is the disposition? What's the attitude of your investor going to be when times are tough? What are they going to do? Are they going to trust you to manage through that? Or are they going to get all nervous, come in, and try to take over the company? Right? That happens every single day. And you just have to make sure you have the right kind of investor who thinks like you do. Right, who has the same time horizon is one thing to look at. How long are they expecting their investment to be in the company before they're going to want a return on it? It might be 1 year, it might be 10 years. And there's no right or wrong to this, but you just have to be on the same page as your investor. If you're starting a technology company, it might take a little longer. It might take 5, 7 years to build that up to where it's going to be something that's sellable. If you're starting another type of company, maybe it's going to take only a year or two, and that's fine. Are they going to want some kind of dividend every year? Again, for a technology company that operates at a loss for a period of time before it hits that curve, that's going to be a tough thing to deliver on, a dividend or some kind of interest yield. But if it's a restaurant chain that you're opening, and you first 6 months you're investing, and next thing you know you hit some profit, okay, then maybe you can give an annual dividend in that type of scenario, and then go back to them and open your second store and open your third store, right? So you have to know the mentality and the mindset of your investor that comes in. That will avoid, I think, 90% of any problems you might have with that particular, with the life of your company from that point of view.
Who would like to ask a question? I know I surprised you. You got one? Somebody on this side. You? We'll take 2 questions. We entrepreneurs get the opportunity to talk to someone like Murray, ask a question, that kind of thing. So I thought it would be good to get a couple questions here.
2 boards of venture capital and angel capital, and we've had deep discussions. This all just came about 3 weeks ago, and I just found out the difference between an angel and a venture capitalist. And some things he was rattling off really fast in his very New York accent that I didn't understand were things like the different kinds of stocks. he said preferred stock and non-preferred stock, and if I invest with you, I'm going to take 51% of different kind of stock and this stock, and I'm like, it was a lot of information. And so my question I have for you is, specifically, is if you could just kind of talk to that, the different kinds of stock and the kind of the game when you come in as the inventor, as the business owner, knowing that they want to take ownership, and how is it that you can get 51% and still have, I mean, that was just a little confusing for me in the different kinds of stocks.
Right. It's a great question. That's a great question. And just to give you kind of it gets very detailed, but I'll just give an overall answer that I think will satisfy the first level of what you need to know. There's primarily two kinds of stock. There's common stock and preferred stock. And as a entrepreneur, when you start your company, you have common stock. You own 100% of the company, and that's common stock. That's just the shares in the company. Now, when you bring in an investor, most investors are going to want something called preferred stock. And all that means is that they have a preference, right? What's the preference? The preference is they get their money first. Okay, that's their preference. So
I prefer that too. That's weird.
And that's really all it comes down to. So they just want to. They're protecting themselves. They're saying what an investor does is they want to invest for the upside, right? So let's just say they get 10% of your company or 20% of your company, whatever the number is. They're looking to say, what is that? I'm paying $1 for that, and I'm going to hope it's going to be worth $5 or $10 one day. So they're investing for their upside, but they have to manage for the downside, right? They got to manage for the downside. So what's the downside? The downside is the company goes bankrupt, the company has cash problems, the company gets sold for a really low amount. And so how do they manage and protect themselves and manage their risk for the downside? And they do that through this preferred stock, this preferred shares. Because in a scenario where they invest $1, and let's just say the company gets sold for $1, but they only have 10% of the company. If they had common shares, they would only get 10 cents, right? But in the fact that they have preferred shares means they get their money out first. And so that dollar that goes to buy the entire company, it actually goes to them, and unfortunately you don't see anything, even though you have 90% of the company.
Okay, that makes sense. Okay, so with that then, how can an entrepreneur who are here, an entrepreneur kind of know that going in? Because one thing he said to me as a New Yorker was, my job as a venture capitalist is to screw you over. And I'm like, well, I don't understand that. He's like, well, you make me money. I'm like, okay, I got that. So he goes, I put money in you, and I want my money 10 times back in 5 years, and you make me money. So I was like, oh, that makes sense. So now I have a boss. Didn't know that. So how can...
I just got to interrupt you there. The first thing I would do is find another investor. Okay. That's the first thing I would do. I mean, they're being upfront. Really I compliment them for their honesty, but I would find a different investor.
Well, but he opened my eyes. He was honest. So he's opened my eyes. So I said, okay, so how can an entrepreneur go to other venture capitalists knowing that positioning and play that?
Yeah, and look, like anything else, there's a market for it. There's leverage. Either you have the leverage or you don't. Either you have a company that is so hot that investors are willing to reduce their bar for what they're willing to take, right? And I've had a friend of mine, his company, he was doing so well, he was so hot that so many people wanted in that he issued common shares as the investment. He said, I have common shares, you have common shares. Too bad. You want it? Fine. You don't want it? See you later. And they were like, but your company's so amazing, okay, I'll take the risk. So it's all risk reward, and they were willing to take that risk in that case. So it's just whatever the market will bear. In tough times where it's hard to raise money, the investors have more leverage. And so they're going to come in and have more onerous terms to protect themselves. But in a flush market where there's lots of capital, everyone's investing, you can go anywhere, knock on any door, and they'll give you money. It just depends on the value, but they'll give you the money. Then you have a little more power over what those terms are.
It's all about growth and your margin and your profit. So if you've got fast growth and high profit margins, you will be able to call the shots a lot more than if you have slow growth and low profit margins. So truly, when you get into these circles, you're dealing with professionals. They know what they're talking about. And if the numbers show, if you can say, look, here's the bank statement, here's how much money is going in, and here's how much coming out, and here's what last month's bank statement, and the line's going like this.
If you have a $100 million business doing 20% growth, 20% margins, and growing at a nice clip, you can do whatever you want. Just to give you, just to that point, because it's a really great point, something to think about when we were talking about making your company the product, right? We were talking about that earlier. Something to think about is, let me give you a couple of data points. Company Walmart, we all know the company Walmart. Walmart does approximately $393 billion in revenue a year. That's close to $400 billion in revenue. It's a pretty astounding number. What do you think the market cap, the value of Walmart as a company is? The value is about $192 billion. Hey, Sima, that's a lot of money, right? That's pretty impressive. Okay, let me give you another example. Google. Many people here probably own Google shares. Well, Google does how much in revenue a year? Anybody know? About $13 billion a year in revenue. 13 billion. Do you know what the value of Google is as a company? $200 billion. More than Walmart. And Walmart does almost $400 billion in revenue. So how could that be? What is that? How does that make any sense? It's to exactly Eben's point. Margins and growth. Google is growing at over 44% a year. Walmart is growing at 5%. And if you say, well, one's technology and one's, retail, look at Target. Target stores. Target does about $60 billion in revenue. And its market cap is at $55 billion. Almost a 1-to-1 ratio. According to that, right, Walmart should be worth $400 billion. But Target grows at 12%, over twice that of Walmart, in a pretty mature market, retail. So it just goes to show it's all about how fast you're growing year over year, and what is that margin that you're bringing to the bottom line every year as well.
First of all, I'd like to say that so far this really has outstripped any expectation that I could have ever had coming to an event like this. I just really want to say that. You've done a phenomenal job with this, and this to me is like the capstone. Yeah, absolutely. And I came here with a little trepidation, not knowing who you were. But can you speak a little bit to creating the value? Because I'm in a situation where I am specifically entering a market in order to sell something off. I'm a trader by nature, so I look at an opportunity and I see the momentum, but I'm a little unclear on what if maybe I don't have a public exit, but maybe like you merged with McGraw-Hill. If I'm going for, say, a larger BD, broker-dealer, or an investment banking firm, how do you establish what that value is going to be?
Do you want me to take that?
Oh, it's all you. I've been talking a lot the last 4 days.
It's a great question. There's something we call comps, comparables, right? So you look at comps as a trader when you're looking at, well, is this stock expensive or is it cheap? Well, what are the comps, right? So you look at comparables to see what something is worth. We live in a relativist financial society. So if my house is worth $1 million, then that house, which is about the same size as down the block, is probably worth $1 million. But if it's in a different neighborhood, maybe it's worth more, maybe it's worth less, right? Everything's relativist. So you have to get comparables for everything you're looking at, including your company. And your company has comparables. They may not be easy to find, but they are out there. And certainly in businesses that have been done before that other people are running, it becomes easier to find comparables. There are many people with BDs out there. A BD is a broker-dealer. It's a license you get in order to be able to trade stocks on behalf of other people, as a broker. Now, there's value in a BD license itself, isn't there? Right? Then there's value in how much trading you're pushing through that particular operation. And so you need to look at that. Those are elements that you need to break down to look at all the different assets of your business and say, okay, well, even if I had no trading going through here, this license itself is worth, I don't know, could be worth $100,000, $50,000, some amount of money to somebody because it just saved 6 months of time for someone else who wants to become a broker-dealer because paperwork, time with government filings, all of that. So time to market is valuable to somebody. Add on top of that your revenue, your team, your computers, your operation, your client base, that all is going to add up to value. And you have to break down, divide up all those assets, look at each one of those comparably in the marketplace, and then you come up with a complete number. And then actually, in most cases, you'll find that the sum is the whole is greater than the sum of the parts. So you'll find that the whole thing, if you find someone who really wants the entire, they'll really value that tremendously.
All right, thank you. Thank you very much.
You're welcome. Awesome.
Thank you, my friend.
Thank you, Evan.
That was fantastic. Thank you.
Thanks, everyone.